Got. All right, Chapter 3, Consolidations. What happens after we acquire a company? How do we operate it? And what changes and what additional entries are necessary for accounting for the operation of a subsidiary, whether it's wholly owned or partially owned, all right, as far as consolidations go. All right, so we're going to use as always, the two entities are going to continue operating as if they were separate legal entities, which they are, all right? So you'll still have an accounting department at the parent and an accounting department at the subsidiary. The only changes is that at the parent, as you get a dividend in, as dividends are declared and received, what happens at the parent level books throughout the year? Same as from Chapter 1. What did dividends do under the equity method? They reduce the investment account, all right? What does the pro rata share of the income do? Increases the investment account. So both of those entries, whether you own 20%, 50%, or 100%, are still being done at the parent level, on the parent's books. Nothing is happening at the subsidiary's books. Okay? Is everybody clear on that? And then everything gets adjusted on the consolidated worksheet. Okay? And we'll go through how that affects everything. So for each subsidiary owned, there is an asset account. Investment in XYZ company, investment in XRQ company, investment in B and C, and every one is listed as a separate account at the parent level, because you have to separately account for each of these subsidiaries that you may have. So you can well imagine just the general ledger entries for the parent could take up an entire accountant's year-end day. If you got 200 subsidiaries, you as the accountant have to keep track of all of your pro rata income on all 200 subsidiaries quarterly to produce, well, every time you produce financial statements. Each and every time. Doesn't that sound like a fun job? I wouldn't wish that on anybody. All right, so we're going to focus on the equity method here. I just want you to know that in your chapters there is an initial value and a partial equity method. Even though they're allowable under U.S. GAAP, I know of no major publicly traded company that does anything but equity method. And I don't think you would get these past your auditors in a publicly traded company. If you were a wholly owned, small, closely controlled company, you might get by with an agreement with your auditors to take one of these other two methods, but I'd be really surprised. Even the small, closely held corporations that I've dealt with in the aerospace business over my career, we always use the equity method. All right? I just want you to be aware of the other two. It could be a multiple choice question on the far section of the CPA exam, but like I said, for any of you that took intermediate with me, if you get to one of those obscure questions, just answer C and move on. Don't waste your time trying to answer, because your clock is spinning. So don't be sitting there spinning your wheels trying to answer a question on a multiple choice in the CPA exam when you could best devote your time making sure you get the others correct. Okay? All right, here's just an advantage of each. This is the acquiring company totals give a true representation. Yes, the initial value is easy to apply, and this does give an approximation. But it's not difficult to apply the equity method, because the equity method, all of this is only affecting the parent's books. So the equity method is only two journal entries per month at most. Your pro rata share of the income is a debit to the investment account for that particular subsidiary and a credit to equity income in XYZ company. Any dividends, that whether they're quarterly dividends or annual dividends, is simply when the dividend is declared, you set up a dividend receivable as your debit, and your credit is the investment account. So I don't know why these two could be easier. I mean, no, that's pretty straightforward. Because none of these three methods is addressing the consolidated worksheet. It's just what approach you take for doing the journal entries at the parent level. So it's only two journal entries. All right. This is the internal reporting. Once again, continually adjusts the equity, reflects the ownership of the acquired company. Income is accrued as earned. Amortization and other adjustments are recognized. So I don't see an issue. Okay. All right. So let's talk about what you're going to do for the rest of the parent. Because if you recall, is it going to follow me? No. Come this way. Thank you. SADI is the acronym for the adjustments you're going to make on the consolidated worksheet. All right? We've already done the first two. Last week we did the S and the A because you've been doing those since the date of the acquisition. So as a review, what's the S entry? Stockholders' equity. For the subsidiary. What's the A entry? Assets or adjustments to assets, both assets and liabilities. Adjustments to fair market value. At date of acquisition. All right? You've been doing those two entries since day one. Well, since last week. You've been doing those two entries. All right? So now we're going to put in the rest of them. So the fair market value adjustments to that entry and the parent, well, okay, so this is the A entry. And then you've got the parent share of the income. You've got any dividends that you've received. So both of this is the I entry. Subsidiaries income. It's just too close to me. There we go. Subsidiaries income. Dividends. All right? Because if you're going to do a consolidated financial statement as if there was only one legal entity, which is the overarching goal of the consolidated, then this whole take the pro rata income from the subsidiary and increase the investment account and decrease the investment account for the dividends, it makes no sense. It makes no sense to pay dividends to yourself. Although, in the case of treasury stock, I suppose that's possible, but it's not. You eliminate those. All right? You need to eliminate the effect of of the reduction of the investment account for dividends, and you need to, for the increase and taking your pro rata share to the income statement. Okay? So that's the I in the D entry. All right, so we acquired parent company. No, we acquired Sun Company on January 1 for $800,000 in cash. And so the book value at the date of entry was $600,000. All right, the net book value. You paid $800,000. However, there are an increase in trademarks with an indefinite life of $20,000. Patented technology is got a fair market value in excess of book of $130,000, and then equipment has a fair market value less than the book value of $30,000. So net of $120,000. So knowing those two pieces of information, how much is goodwill? $80,000. Because you paid $800,000 for $600,000 worth book value of assets, but there was a differential of $120,000 between fair market value and book. So $80,000 is goodwill. All right? And that's what's here. Okay? So here's our calculation. Excess $200,000. $20,000 in trademarks, $130,000 in patent, negative $30,000 here for $120,000. Goodwill is $80,000. Both the patent and the equipment has a limited life. So you have a reduction on an annual basis for the next 5 years of depreciation expense by $6,000. That's the $30,000 fair market value reduction in fair market value over book value. So the subsidiary is going to keep depreciating that asset at the $150,000 level. All right? You only are buying it at $120,000. So you need to reduce the depreciation expense each year for 5 years by $6,000. Because you didn't buy $150,000 worth of tangible fixed assets. You bought $120,000. Does that make sense? I get a lot of blank stares. Yes? No? Yes. Okay. Otherwise, I can go at it from a different angle. The patented technology has a useful life, not a legal life, because remember you amortize patents over their useful life, not their legal life. Don't fall for that mistake on the CPA exam. Think of it logically. If you're only going to use the patent, in this case for 10 more years, it doesn't matter if it's got a 20-year legal life. Because it makes no sense to amortize something under the matching principle between revenues and expenses. If you're going to stop using the patent and stop generating revenue with it, it doesn't make any sense to continue to amortize it. Right? So don't fall for that trap, because that trap I can almost guarantee you on the CPA exam. They are going to give you a legal life that is longer than the useful life, and then ask you how much the amortization is. All right, so then we've got an additional $13,000 for the next 10 years. So after 5 years, this depreciation adjustment is going to go away. But the 13 will then continue on for the next 5 years afterwards. All right? And that's the E entry, the expense adjustment. And primarily, it's amortization and depreciation. It can be a discount or a premium on a bond. If you acquire a bond in a liability that has a premium or a discount and the fair market value of that bond has changed, It could be an interest expense adjustment. I'm just warning you. None of the examples I'm going to go over in class or on the midterm do I give you that type of problem. But it could be. Primarily, it's either amortization or depreciation. Okay? It's an amortization of some kind of intangible asset, whether it's customer relations, a trademark, a patent, whatever. All right? It's copyright. It's some sort of intangible asset. Okay. So here's our journal entries, recorded at the parent level. So at the parent level, we did our investment of $800,000 in Sun Company, and each one of these investment accounts are going to name the subsidiary. It's not a generic, like when we were doing the fair value, where we either have an investment in trade, available for trade securities, or available for sale securities, or an investment in trading securities. That's a generic. It doesn't matter how many different stocks you buy in those accounts. When you start investing more than 20%, you specifically identify in your general ledger what the subsidiary is. In this case, it's Sun Company. All right? Then they record the dividend, $40,000, reduce the investment, and then this one doesn't matter. They pay the cash, had no effect in the investment, and then they record the $100,000 income that was earned at the end of 2014. All right? And then lastly, they reduce that equity earnings by the depreciation. Well, the excess depreciation over the excess amortization over the reduction in depreciation. So it's a $7,000 reduction. So on the parent company, they will have earnings and equity earnings and subsidiaries earnings of $97,000, $93,000. The $100,000 minus the $7,000. All right? All right. Here's the SADI entries again. The S entry is eliminate all of the subsidiaries' stockholders' equity. So beginning retained earnings, common stock, paid-in capital in excess of par. Those three accounts. And if it had a complex capital structure and it had preferred stock and excess paid-in capital in excess of par on the preferred stock, you'd eliminate those two. Everything that's in the stockholders' equity. All right? Recognize the unamortized. Now this is key. Allocation of the beginning assets. Because what's going to happen year after year after year, $30,000 reduction in tangible fixed assets that we had in this example, that's going to go down every time we reduce it by that $6,000 reduction in depreciation. So at the end of year 2, your A entry is not going to reduce the fixed assets by $30,000. It's going to reduce it by 24. At the end of year 3, it'll reduce it by 18. 4, it'll reduce it by 12. At the end of year 5, you're going to reduce it only by the remaining $6,000 worth of undepreciated fixed assets that you have, tangible fixed assets. The patent is going to go, what do we start on the patent? I forgot. I know it was 13,000. Does anybody remember? Huh? 130. So it's going to go from 130 down to 117, down to 104, down to 91, on and on and on. Okay? So the A entry is the unamortized or undepreciated allocation of fair market value in excess of book. So that's a key difference. Now, your midterm problem, I'm giving you the end of the first year. I think. I'm pretty sure it is. So you only have to deal with it since acquisition. All right? But we're going to go over examples of this after the break. Okay? All right. The D entry is eliminate the dividends. Because it doesn't make any sense to pay dividends to yourself if you're consolidating into one single set of financial statements. All right? Eliminate the income. You, in this last, took a debit to the investment in Sun Company for $100,000 and a credit to equity earnings in subsidiary for $100,000. Doesn't make any sense. You're going to take all of their earnings, which next week I'll tell you how crazy that sounds sometimes if you don't own 100%. Because when we consolidate a not wholly owned subsidiary, we consolidate 100% of every account, including all of their revenue and all of their expenses. You could own 51% of somebody and still take 100% of their revenues as your revenues. Now, there's an adjustment in there, down at the bottom, for minority-owned interest. But I always thought that was a little odd, because the one thing we don't like in accounting is just generating revenue and expenses in excess of what we've earned. And we didn't earn all that. We only earned our portion of it. I digress. Yeah.
Because you own the most percentage?
You own the controlling interest, yes, and you're consolidating it, yes. That's the reason behind it, but I always thought it was odd, especially for the revenue and expenses. I don't know. I always think it's odd too. You're taking 100% of their cash, 100% of their receivables, 100% of their inventory, 100% of everything, all their fixed assets. You don't own 100% of their fixed assets, but yet you're consolidating 100% of them. And then you're just taking out one little part in your stockholders' equity section. You're backing out the portion of net book value, assets less liabilities, that you don't own. Anyway, I digress. We'll talk about that again next week. I always thought it was odd. And then recognize the excess amortization for the current year, because you're making adjustments to the A entry year after year to reduce that difference between fair market value and book value at acquisition. So all you're taking on the E entry is the adjustment for current year's expense, which in that last example was $7,000 per year for years 1 through 5, and then $13,000 for years 6 through 10. And then after 10, E entry goes away. Eventually, all E entries go away, because eventually you're going to amortize fully whatever it is you bought. Right? Okay? All right. There's the SADI entries. Here's the entry for S. You eliminate the $200,000 worth of common stock. Paid in capital. Note here that they're eliminating retained earnings at the beginning of the year. Semester after semester, the things that I see people doing on the worksheet that hopefully you already started on for the midterm is they try to eliminate the ending year retained earnings. The retained earnings that's down at the bottom on that worksheet. You need to eliminate the retained earnings that's in the middle of the worksheet. Because the worksheet that I gave you all has revenue and expenses at the top, and then it's got a very abbreviated statement of retained earnings in the middle. And then it's got the assets, liabilities, and stockholders' equity. Well, a lot of times they're going to want it for the S entry. Everybody always wants to take the retained earnings at the bottom, not the one in the middle. It's the January 1 retained earnings. Okay? So make a note of that, because otherwise your investment account will not go to zero. And that's, if it doesn't go to zero, you've done something wrong. Okay? Because it will. Okay. The A entry was the increase in the trademarks, the patented technology, and the booking of goodwill. and then the reduction in the equipment. And this is the end of the first year. So both of those, the patented technology and the equipment, are both at the full 130 and 30 right now. But those are the two amounts that are going to slowly shrink year after year after year in year 2, 3, 4, 5, on up to 10. All right? And then those two will go away completely in year 11. You will have no more A entry adjustments for those two because they will be fully amortized and depreciated. All you'll have at that point is the booking of the trademark, goodwill, and then your investment account will reduce only by $100,000 in year 11. Does that make any sense? All right. Yeah, so fair market adjustments may be reduced by any depreciation or amortization taken prior to your consolidations. Okay, the D entry is to eliminate the dividend that was declared and put it back into the investment account. All right? Because you're not paying dividends to yourself anymore. The only thing you're going to report on a consolidated basis is dividends paid to unrelated third party or unrelated shareholders of the parent company, not the subsidiaries' dividends. And then the I entry is to eliminate the net, because we had $100,000, our 100% pro rata share in the subsidiary's income was $100,000 less the amortization / depreciation of $7,000 that we took. So we need to take out the equity in subsidiaries' earnings, because we're going to be consolidating all of the revenue and all of the expenses into a single financial statement. All right? So those are the entries. And then we're going to depreciate and amortize. So the amortization expense is a debit to increase it for the $130,000 patent, and then we'll take it to patented technology or accumulated amortization, patented technology, whichever one you use. And then the equipment or the accumulated depreciation is for the reduction in depreciation. They're taking it to the equipment, but more than likely there's an accumulated depreciation account at the subsidiary level. Okay? Everybody good? All right. All right. I'm going to note this. It's not on the midterm, but any receivables or payables, whether it's a note payable, a trade account payable, anything that is owed from either the subsidiary to the parent in a downstream loan or an upstream loan from the subsidiary to the parent. So if the parent owes money to the subsidiary or the subsidiary owes money to the parent, you are at that point in consolidation overstating your liabilities and your assets. So you need to eliminate any intercompany. And a lot of times that, if you go to work for even a small, closely held company, that is the one account that the junior accountants never reconcile. It's just the hair that I have lost over intercompanies, because they should equal, right? If I send an invoice from the parent to the subsidiary for anything, buying inventory, providing services, renting out the corporate airplane, whatever it is, there should be an offsetting payable at the subsidiary to the parent. Yes? Never. Those two accounts never reconcile. It's just lunacy. And then you get there at year end and you're looking at it, and now you've got 40,000 transactions in the general ledger in those two accounts that you have to go line by line by line. And you're comparing a GL from one company to a GL of another company. Remember? Because you're looking at the payables here and the receivable here. And you need to make sure they match, because inevitably somebody didn't book something along the way. Or payments were made from the subsidiary to the parent, and it was a partial payment, and your accounts receivable clerk at the parent applied it, misapplied it. They were partially paying something else, and they're under a lot of time constraints. They've got to process the paperwork. So they booked it inadvertently to the wrong account, and then you canceled the one invoice, and it's just a mess. All right. Let's see. So we talked about everything in here. Yes. So all of the subsequent, you're going to, the total revenues, the total expenses, you eliminate all the investment or dividend income. The retained earnings balance at the parent is what should fall out, because you've eliminated the subsidiary starting balance and only included the current year's net income on a consolidated basis. All of the assets and liabilities are added together, plus any adjustments. And then you eliminate any intra-entity receivable or payable. And then the goodwill is booked at the parent level, and the capital stock in additional paid-in capital is also parent only. So when you get to the end, your stockholders' equity section should match the parent. All right? Because it's all that's left. You've eliminated all the subsidiaries' stockholders' equity. Okay? Yeah. Okay. All this slide is saying that whatever method you choose, whether it's the equity, the partial equity, or the initial investment method for accounting for the subsidiaries, it has no effect on the resulting consolidated financial statements. All right, goodwill. This is a fun topic. Goodwill, as you know, it has an indefinite life. You do not amortize goodwill. That has changed from when I was sitting in your place. Back then, you used to amortize goodwill over 20 years. We don't do that anymore. You have to do a calculation for impairment. And I'm going to briefly talk about it, and then we shall never talk about it again. The calculation for impairment is two-tiered. All right? You're going to recalculate the goodwill as if the acquisition happened at the balance sheet date. All right? You looked at the book value of the subsidiary. Okay? Does the book value of the subsidiary compare to the current fair value? As if you had to buy that subsidiary all over again at year end. If it does, the fair value is higher than the book value, which you would hope it would, because you've been continuing to operate this thing since you acquired it, and hopefully it's been operating in a successful fashion. If the fair value is higher, in other words, revenues have increased annually and everything's rosy, then you do not have an impairment. If it doesn't, then you got to go through and this is just a good faith estimate. They don't expect you to go out and hire all of the appraisers that you did at acquisition. You're just stating that inventory is worth this compared to book. Fixed assets are worth this compared to book. And you redo that calculation, and if the goodwill that comes out of that calculation, comparing the fair value of the subsidiary to the book value of the subsidiary, coming up with an excess, and then allocating it to specifically identified assets and liabilities. If the goodwill calculation that falls out of the bottom of that exercise is less than what the current goodwill balance is, then you have an impairment, and you write it down to what it would be had you made the acquisition at year end. For each and every subsidiary that you have goodwill for. Now there's a full-time job. Right? Every one. So in reality, you've got to get it close, because in almost every case, the fair market value of the subsidiary is going to be higher. It's only if you've made a really, really bad investment in some subsidiary and the whole operation is starting to tank that you get into this with the auditors. Because at that point, if you're still carrying goodwill associated with that acquisition, and that acquisition has gone to hell in a handbasket, then you're more than likely going to be forced into an impairment calculation. But it is a two-tier calculation. All right. If there has been a permanent decline, now if you sell a portion of the subsidiary, then yes, goodwill, that portion is associated with the subsidiary goes away. I mean, if you sell all of Sun, that parent owned in that last example, it makes no sense to keep carrying the $80,000 worth of goodwill that you calculated at acquisition, because you got rid of the subsidiary. You don't own it anymore, right? So that makes sense. But if there's been a permanent decline in the value of the subsidiary, then you have to do this impairment calculation. So step one, the fair value with the allocation is compared to the carrying value, including goodwill. Does the fair value exceed the carrying value? And in almost every case, the fair value of an asset that you've been operating should be higher than the book value. Because think of your fixed assets. Even buildings, you depreciate over time to zero. But the fair value of a building never goes to zero, right? Land. Well, land doesn't get depreciated, but it appreciates in value. Okay? So if this fair value calculation, and it's just an estimate, it's a good faith estimate, you've got to have a worksheet for each and every subsidiary that shows what the fair value is compared to the carrying value is just book value. That's all of the assets minus the liabilities. Okay? That's step one. Is it higher? And in most cases, it's going to be a yes. If it's yes, you're done. Goodwill is not impaired. You do not need to go to step two. If it's not, then you have to do this second step. And the second step is you allocate the fair value of the reporting it to all of its identifiable assets and liabilities. This is the same thing you did at acquisition. You just repeat the process. And then subtract the fair value of the net assets from the fair value of the reporting, and look, you're redoing the goodwill calculation. All right? So the fair value is reallocated to the specifically identified assets. And then if the implied goodwill is less than the recorded goodwill, in other words, in that same example for parent and son, if you came out the bottom, when you got all done with this, at a $60,000 goodwill calculation, rather than the $80,000 goodwill calculation, you've got a $20,000 impairment loss for each every subsidiary that you've got goodwill booked on. Yeah, this would drive you to drink. Here's a flow chart in case you didn't get you the first time. It's in your book. Don't worry, I'm not going over it. If the implied goodwill is not less than the recorded, there's no impairment. And if it is, then you take an impairment. All right. Yeah. And then they give you a whole bunch of examples in here. I'm not going to go over this. I would rather focus on the saving. See, all they're doing here at the end of 2015 is they're just reallocating the calculation. So here's the fair value of this particular subsidiary, $600,000. They go through all at an allocation of the specifically identified assets and liabilities, and they come up with $956, which would have resulted in a value of $4,000 or $4 million in goodwill, but they have goodwill on the books when they first made the acquisition of $155,000. So they take an impairment loss of $151 million. Okay. Keep your fingers crossed.